As a trader, you can click buttons anywhere in the world and make an income for the rest of your life, but without a clear strategy, you will waste thousands of hours and your hard-earned dollars on strategies that just don't work. I've been doing this for 5+ years and make well over $30,000 a month clicking buttons using the same exact strategy I'm going to teach you today. This is the full course on how to make your first $10,000 trading. You've probably seen this before. This is the trader's journey. You put a couple $100 into your Robinhood, and then of course the first play you take, you're going to make money. As did I. The first $50 options trade I took went to $10,000. But shortly we realized that 90% of traders fail. So what happens is we lose all of our money. Then this is where the real journey begins, or as I like to call it, the trenches. Why do we call this the trenches? Because this is either your quit or continue moment. You can give up and fall victim to 99%, or you can continue with a profitable strategy that starts working, you make your money back, and then you have success. I want to make it very clear. I didn't start off profitable. I started with a monitor I found in my mom's basement and a computer chair I found out front of a sorority house in college. That is how I started trading. This was my setup. Now, fast forward over here, you can see the old Samsung monitor. I had a trade go 97% in the red, and I was up $133 on my current position. This is how I started. I did not start making money. I lost for 2 years before finding any green, and recently I hit a PR. I made $26,000 in just 1 week of trading, or 5 trading days. Before you say, Ellie, your profile picture is a girl, why should I listen to you? Anyone can post Photoshop Weeble screenshots. There's no proof you make any money trading. You're just a glorified gambler. I get that a lot. But here's a screenshot from August 2021. 48% return in the month of August. Here's some 0 days in 2022 and 2023. Here you go. Here's a $500 screenshot on a quick scalp. And now fast forward to today, here's 70% or $3,000 making in the stock market. I've been doing this for 5+ years, okay? I had a student recently, last week, 185% in 1 day. Another student of mine, all-time green on the account with a little bit of extra on top, meaning profitable trader status achieved, 31% in just 1 day. Again, I've been doing this for 5+ years, and I've taught hundreds of students this same exact strategy. But before we talk about the fun side of trading of, the Rolexes and the Miami penthouse, there is a dark side, and we need to be well aware of the dark side when we begin our trading journey. To become a successful trader, you need to put in the work. That means screen time, journaling, understanding setups, night times, 3 a.m.s on the weekends, working, grinding, constantly improving your craft. But luckily for you, you don't have to do all that work. I will explain exactly how my strategy works, but I want to caution you. At the end of the day, you push the buttons. I cannot push the buttons on your brokerage for you. You have to push the buttons, and that's why it's incredibly important that you need to think like a trader. Someone told me a long time when I first started trading that a good trader is a good loser. And I laughed and I was like, well, that doesn't make any sense, because wouldn't a good trader be a good winner because they win all the time? Let me explain. Here is a coin. This is just a regular coin. And we're going to split it down the middle, because that means there's a 50% chance that it lands heads and a 50% chance it's going to land tails. Now, every time it lands on heads, we're going to make $100. Every time it lands on tails, we're going to lose $100. So let's say we flip this coin 10 times, or based on the probability, based on the math, there's a chance that we only lose maybe $100 or maybe make $100, right? Or just break even based on the math. But here's the thing about probability is what happens when it lands tails 9 times in a row? Minus 100, minus 100, tails, 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 right? Now you're down $900. What are you going to do? You're going to ask, how is that possible? I thought it was 50-50. That is just the way probability works. How would that make you feel when that coin lands on tails 9 times in a row? Are you going to feel angry and go on tilt? Maybe you just want to quit trading and go do something else. Or maybe I need to flip it a different way. Try a new trading strategy. That is the wrong way of thinking. Okay, trading is a game of probability. So let's use our magical odds boost and let's increase our probability to 70-30. Our magical coin now is 70-30. There's a 70% chance that every time we flip it, we're going to make $100. And there's a 30% chance every time we flip it, we're going to lose $100. So you know that this magic coin literally prints money. How many times are you going to flip the coin? Are you going to flip it once, twice? No, you're going to flip it while you're sleeping, while you're making breakfast in the morning, till your thumbs fall off. And then once your thumb falls off, you can use your index fingers. You can use all your fingers. You're going to have calluses because it's literally an infinite money glitch. That is what trading is. It's a profitability glitch. So before we get into the actual course materials, there's some things that we need to state. I trade on the 10-minute chart. I do not trade on the 1 minute, and I do not trade on the 2 minute. You're going to ask, well, why not the 1 minute or the 2 minute? It's because it's too fast for new traders. The 10-minute chart forces patience. Next, I trade with the trend. Okay, if hedge funds are buying a stock and it's going up and to the right, I want to join the hedge funds. They're way smarter than the average retail investor. Number 3, I always hold a runner. A tiny part of my position is held until the trade stops working. These runners are notorious for going 2, 3, 4, 500%. And lastly, I let my trades work. I did not work my butt off for 5 years to not let my thesis play out. That is not how trading works. And for you studying for the last couple of weeks, months, or years, becoming a profitable trader on your journey, this is not the way. You have to let your trades work and play out. Don't be scared. And lastly, I trade on Webull and I use TradingView for my charts. So let's talk about candlesticks. Most traders, well, I would say most profitable traders use candlesticks. And you can see, so the most bullish candlestick is the Dragonfly Doji, and the most bearish candlestick is the Gravestone Doji. So what does that mean? If we just take the Dragonfly Doji and combine it with the Gravestone Doji, we can take any of these candle cheat sheet charts and chuck it right into the trash because it's all a bunch of noise. And I'm going to explain to you how. Okay, so we know that a Doji candle, okay, or a Dragonfly Doji looks like this. We know that buyers are in there and we know that it's bullish. Same thing. If we have sellers in here and we have a Gravestone Doji, we know the trend is down. Now let's just add these two together and congratulations. What do you notice? Bottom wick means buyers, top wick means sellers. And if there's the same amount of sellers as there is buyers, you get a Doji candle. Congratulations, you just learned how candlesticks work and the basics of price in about 3 minutes. We don't want a big wick in your face. Let me explain. Let's talk about the big wick effect. So we can see over here, we have a Gravestone Doji at the top of this bullish trend. What happens? Price goes back down, signaling a trend reversal. Similarly, over here, we can see it's a bearish trend. It's going down to the right, and then we see a big old wick, aka the big wick effect, and then price resumes up and to the right. If you actually look over here, you can see all of these big wicks, top wicks, because that means that there's sellers and price is going to the bottom. And then the trend shifts, okay, big long wick off the bottom, and then trend goes back up. This is the big wick effect. There is 3 types of trend. There's bullish, bearish, and chop. A bullish trend is when price goes up and to the right and you want to buy calls. A bearish trend is when price goes down and to the right and you want to buy puts. And you're going to see something that in chop, it goes up, down, up, down, up, down, up, down, up, down. And what we call this is ping pong. All of your gains are gone. Why? Because it's ping ponging up, down, up, down, up, down, up, down. And what's happening to your P&L is you're getting chopped up. Notice how it's not green like bullish is and it's not red like bearish is. It's somewhere in the middle. So let's talk about how to identify trends. There's bullish and there's bearish. Notice there's no chop here, okay? We do not trade chop. So how to identify trend? Notice there's no chop here. There's bullish and there's bearish, or there is no trade. For a bullish trade, if it's above the pre-market high or the previous day high and the ADMA, it is bullish. If you have trouble remembering this, remember, if a stock is making highs, cough, cough, high here, cough, cough, high here, it is bullish. If a stock is making lows, okay, it is going down to the right. Therefore, it is bearish. See the lows right here. So it has to be above. It has to be making highs. For bearish, it has to be below. It has to be making lows. That is how you identify trends. So just a quick recap. Bullish pivots are above the pre-market high or above the previous day high, and it's above the 8 EMA. For bearish trends, it's either below the pre-market low or below the previous day low and the 8 EMA. It has to be below for bearish and it has to be above for bullish. That is it. That's the easiest rule to follow and how to identify trends. So let's talk about this more in a little bit more detail. Let's talk about the bullish trend rule. A stock has to break either the pre-market highs or the previous day highs, bullish because we're going higher, for a trend to form. Okay, so a stock has to break these levels in order for there to be a chance that a trend actually forms. Once a trend forms, this is major key here. If it is above the 80 EMA, a trend is established, or we can say that a trend is now confirmed. So we can see, yes, it is above the 80 EMA here, but it is not above the key levels. Therefore, we do not know if a trend is forming or if the trend is established until, look, it breaks out of all the levels, comes back down, establishes the trend. So now the trend has formed because it's above both these levels. Okay, so we'll put a 1 there. And then 2, it comes down, taps the trend. Now it is established. And you can see what happened. It went up and to the right. Let's talk about the trend rule in a bear situation. A stock has to break either the pre-market low or the prior day low. Remember, it's going lower, so it's bearish for a trend to form. Once a trend forms, if it is below, remember, because we're making lows, it's bearish, the 8 EMA, a trend is established. So it's very similar, if you recall, the bullish trend. So in a bullish trend, we were waiting for the trend to form and waiting for it to establish. But in a bearish trend, it's exactly the same. So it breaks these two levels here, the previous day low and the pre-market low, and then it comes up, taps the 80 EMA, rejects, trend is now established. So let me circle this. So that's 2 because the trend's established, and then the form it's kind of close, but it's at the top. A trend is now formed, and look, it floods down to the downside. The floodgates are open. Your puts in a play like this are going 200, 300, 400%. On a small account, you can't fathom how much money you can make on moves like that. Okay, that's great, but Ellie, where do I enter? This is the grand reveal of the LE model. Okay, LE, get it? It's very similar to my name. LE, LE. This way, you'll never forget where to enter a stock. And the L in the model stands for you enter on a level. And the E stands for entry on an EMA. So, tying it all together, the LE model. This will change everything for you, and you will never have a bad entry again if you pay close attention. L, entry on a level. We can see it breaks our 2 levels. Remember, so the pre-market low, the previous day low. So now the trend can form. Okay, and now we want to wait for the trend to be established. So it comes up, it taps the 80 EMA, so it's established. So we're good. So now we know we have a continued bearish trend. Now, where do we enter? Entry on the level. It comes up, it pops, tests the previous day low, and then rejects and comes back down. That is your level. So here's your level right here, previous day low, and congratulations, these contracts went absolutely nuclear. So now let's talk about the E for entry on EMA. All the time, traders say, yo, Ellie, I missed the L and the LE model. What do I do? And I say, dude, just use the EMAs. That is why it's called the LE model. It's levels and EMAs. But remember, L comes first because levels are stronger than EMAs. However, if we do not get a retest, we need something else to use risk. Now, E, entry on EMA. Is the trend established? Has the trend formed? The answer is yes, yes. The trend is bearish. It broke the pre-market low, broke the previous day low. It's below the 80 EMA. It is bearish. But check this out. Where is the retest for the previous day low or the pre-market low? I'll give you a second to look. The answer here is there is no retest. It did not test a key level. So what do we have to do? We have to rely on EMAs. And you can see, comes down, taps the 80 EMA, and then goes back down. Comes up, taps the 80 EMA, and goes back down, taps it one more time, and then continues back to lows. This is not 1, this is not 2, this is not 3 entries. Okay, you could have played this stock all day and literally tripled your money almost risk-free. This is the power of the E in LE model. So, I hinted at it last time, but now I want to talk about using both for more entries. And I don't want you to think of more entries as in over trading. It just gives you more opportunities, more chances, just like the Eminem song. If you know, you know. Again, always follow the process. At the end of this video, you're going to understand my process of how I view things. I start with levels, then EMAs, and then I look for my entry, and then we'll talk about exits later on in this course. We break the pre-market highs, we break the previous day high, trend is now forming, taps the EMA, now it's established, and now we can look for an entry. You can see Not only is it an EMA retest, it's also a level retest. So you get 2. So that means the trade is A+++. Okay? Very slim chance. Remember our magical coin. This is a 90-10 flip. You're going to take this 10 out of 10 times. What happens if you miss the pre-market high retest? That's okay. There's an entry here because it comes down and taps the 8 EMA. There's another entry up here because it comes down and taps the 8 EMA. This is perfect for people who cannot trade during the open and seem to miss a lot of trades. There was not only one entry here, there was another entry, and there was another entry here. This is how you trade. Make money how you can. Moves like this are how you build your portfolio. Here's a bearish example of using both. So we come down and notice in this area here, is there an entry? No, because look how extended it is in this area. It's too far away from the EMA and didn't retest the pre-market low until it breaks the previous day low. Think back to our trends, comes back up, taps it. It did get above it for a little bit, but then lower high, taps it again. So, and then flushes down. So what if you miss this entry right here, entry number 1? Don't worry, it comes up and taps the EMA right here and right here. So don't be afraid if you miss a trade. There's always another entry. If you miss a previous day low retest, it's okay. Look at all the other entries the EMAs offered, and these contracts went 220%. Using both example again, pre-market low. Okay, pre-market low breaks. But what happens? We don't get a clean retest. This is a retest here, sure, but it's not as clean as you would like it. Price starts to consolidate, form a bit of a bear flag here, and then what? It comes up, taps the EMA, entry number 1, and floods out. You would take your profits at previous day low. But then, what happens? It breaks the previous low. In this area here, is there an entry? The answer is no. Okay? LE. Where's the level in here that it's retesting? It didn't retest the previous day low. It didn't retest an EMA up until, boom, entry number 2. There you go. So it comes up, it retests it, and then washes out. And if you missed that entry, it gave you another one down here where it came up, tapped the 8 EMA, and then washed back out. These contracts went 255%, and that was on a late entry. You do not have to get up here in order to make gains like this. Remember, LE, levels, and then EMAs. So I get probably 50 to 100 DMs a day across all platforms, and these are mistakes I see all the time and how you can avoid them. Please listen very carefully. Traders will randomly buy off EMAs. Yo, Ellie, what indicators do you use? I tell them, they put it on their chart, and what happens? The market decides to ping pong, all your gains are gone, aka there is no trend, and they're trying to buy off the 8 EMA all day. Then they send me a message. Yo, Ellie, I lost all of my money trading your strategy. This is a terrible strategy. And I say, well, the first part of the strategy is, did a trend form? If it did not form, then there is no established trend. Therefore, the EMAs are basically worthless and you should not use them. Remember, has to break a key level, then come down, touch the EMA, and continue higher or lower. That is a trending stock. Otherwise, it is chop. Next, buy high day and low a day. Nowhere in this presentation, in this course, have I said that you should enter on high a day or low a day. The reason you're doing that is because of FOMO. Lastly, waiting. Okay, I made this gold because you'll buy yourself a big gold Cuban link if you just wait for the setup to come to you. Don't rush it. Don't force it. There will always be more opportunities. Again, when you're waiting for those pre-market high retests or those pre-market low retests and you miss it, use the EMAs. They're on your screen for a reason. Don't forget, traders are always risk focused. Okay, risk is at the front of our mind, meaning we're always worried about how much money we're risking versus how much money we can possibly make. Now, we went over the entries, we went over the trend, we went over the system. Question I get all the time is, where do I set my stop? It's a great question. All you do for stop is set it at the high of the previous candle or the low of the previous candle on a 10-minute chart. Okay, so your entry would have been up here, your stop loss would have been above that candle. It's really simple. Now, your next question is okay, where do I sell? You're going to sell at the low a day. Think back to common trader mistakes is we're not buying at the low a day, we are selling at the low a day. We're going to sell to inexperienced traders who have FOMO and are chasing the lows. Now, well, Ellie, I see that the stock went down a whole bunch. all you're going to do is move your stop loss to the high of the previous 10-minute candle over and over and over and over again. Remember, our stop loss was up here. So it goes lower, stop loss, lower, stop loss. And you just keep moving it down. And you just move this red line all the way down until eventually you would get stopped out. Let's talk about this in a more simplistic term. On a bullish setup, okay, so when you're in calls, your stop loss is going to be on the previous 10-minute candle low. Okay, so here's your stop loss. In a bearish situation, okay, you're buying puts, your stop loss is going to be at the high of the candle. Why? Because you're shorting the pops when it's bearish and you're buying the dips when it's bullish. Okay, this is too far of a dip, meaning it would stop you out. This is too high of a pop, therefore it would stop you out. Back to it. You can see, here's my stop loss for this trade. So you would enter against the ADMA tap. So there's your entry. I'll put a 1 there. My stop loss is at the high of the previous 10-minute candle. And then it breaks down to the lows. We're going to take some profits. Stop loss goes here. Remember, high of the 10-minute candle, high of the 10-minute candle, and then it goes lower and eventually would have stopped us out right here. But notice how much of the move you actually captured. You captured 2 low a day. So 1 here and 1 here. Same as this entry over here. So we entered off the ADMA tab. Your stop loss is going to be low the previous 10-minute candle, and then it goes higher. Now your stop loss is here, goes higher. Stop loss is here, goes higher. Look how much of the move you captured. Not only did you get high a day, you also got new high a days. Your contracts went absolutely nuclear here. Key notes here, your stop loss is the high or low of the previous candle, depending on if it is a bullish or bearish trend. Now, let's talk about small accounts. Yo, Ellie, I have a small account. How much should I put in a trade? How much should my risk be? These are questions I get all the time, so let's finally settle it. If you have a $1,000 account, remember, add an extra 0 to all this. If you're trading a $10,000 account, 20 to 30% of your account per trade, or about $200 to $300. This does not mean that you're going to lose $200 to $300 per trade. This means at most your risk is going to be $50. This is position size versus what your actual risk is. Your reward is going to be 10% of the account or $100. This will give us a 2-to-1 risk reward. When trading, a 2-to-1 risk reward should be absolute minimum, and I'm going to show you why. It's just math. If you take 5 trades and you win 2 of them but lose the next 3, you make $50. If you win 2 trades but lose 2 trades, you profit $100. If you win 3 trades in a row but then lose the next 2, you still profit $200. Notice how nowhere in here is my loss $300 or my entire position size. That is why we covered stop losses previously. Now, tying all this together, do you remember that magical coin in the beginning of this course? The magical coin is you, because you now have a profitable trading strategy.